we've been on the bull side for quite a while, and we continue to be. Now, right now in the July-August period in the United States, the markets are Barbie-type markets. They're pink, they're pretty, they're not terribly substantive, the volumes are low, but the economic backdrop, I think, supports the notion that stocks are going to work higher. Everybody concentrates on the Fed. Everybody's looking at the Fed rate hikes. Everybody knows what's going to happen next. I'm old enough to go back to the Paul Volcker era. Paul was on the board of the Prudential Insurance Company when I worked there, and he said something that is quite interesting, quite pertinent today. He said businesses can operate very profitably as long as they know what the backdrop is for planning. What's the fiscal backdrop? What's the monetary backdrop? And if there's not radical change, then their ability to maintain profits and profit margins is very strong. Many people today are looking at 5% interest levels, which is about the norm here in the U.S., as being extraordinary. They aren't. For decades, businesses operated in a 5% environment, had ample profit margins, and I think the U.S. economy today and others around the world are showing that they can do very well as long as they know what the future fiscal and monetary backdrop is going to be.
For sure, George. I mean, as you say, companies have operated in 5% interest rate environments forever, and it's never been a problem, and it's never been profitable. But on the other hand, companies have never been operating in quite the same kind of disastrous economic backdrop that we've seen over the past 10, 15 years. And so the necessity for the zero interest rate policy created an entirely new dynamic. And we're still playing out the backwash of that dynamic, aren't we? I mean, we're not back to a position now where everything is hunky-dory, everything is economically stable, and businesses can now plan ahead with 5% interest rates with absolute confidence that everything is settled.
Certainly, the economic world is still working off the backwash of the pandemic, of COVID, and of a lot of other very negative things. But if you look at the supply chains, they're much more normal now than they were. If you look now in the U.S. at the banks, there was a mini crisis with a few banks, but the others are actually reporting both results and future forecasts that are better than anticipated. So it's easy to be a Cassandra. It's probably more positive to be negative. You're less apt to be criticized if things go down. But in the U.S., and that's the only market that I know well, the economic backdrop is quite solid for 2023 and going into 2024.
Actually,
the surprise if there is one.
Sorry to interrupt. It's not easy to be Cassandra at all, because the markets have been going up and up and up on the basis of valuations that everybody thinks is quite strange. Earnings have been, softish, not great, not terrible, and no one can see why the markets are going up in any particular way. You're calling for an S&P at 5,000 now, which for 2023 would be a 25% increase on the start of the year. There's nothing Cassandra about that. That seems a little bit frothy, doesn't it?
I would say realistic, not frothy. The market in 2023 recovered from a debacle, a dismal 2022. So the rise of 16% in the S&P is recovering part, but not all, of last year's losses. And secondly, markets are forward-looking. I think that earnings in 2024 are going to be quite a bit better than the early projections, and that, again, coupled with animal spirits, gives one a strong belief that valuations are not extended and that investors in a comparatively benign economic environment will be optimistic. Now, exogenous catastrophes can throw all that into a cocktail. War, plague, geopolitical disasters can of course occur, and that really is hard to if not impossible, to anticipate.